This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Good morning, ladies and gentlemen. Welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and for the next hour, we're here on News Radio 102.5 WFLA talking about a variety of things that have something to do with your finances, whether it be your mortgage, your investments, your taxes, your 401k, your mutual funds, your stocks, your bonds, your retirement income, your Social Security, your retirement plan itself. All of it is fair game on the program. We'll tee it up with our topics du jour. We will, of course, talk a little bit about the trade stuff. That's big headlines, and so we always like to spend at least a few moments on the program sort of recapping the week that was and hitting those topics. We've also got some cleanup from last week where we started to talk a little bit about planning your retirement income. Interestingly, almost half the folks out there that are approaching retirement don't really have a game plan for how they are going to replace their income in retirement, because, of course, once you get to retirement, the paycheck stops. So where's the money going to be coming from and how? All kinds of things to consider in that discussion. We started that last week on the program, but we simply ran out of time. Also on the program today, we're going to spend some time talking about ETFs versus mutual funds. ETFs have become very popular out there, and we want to do some compare and contrast. Recently, I had a conversation. Actually, it was the same conversation that happened on the same day, which I guess in my mind means it's becoming a bigger and bigger issue if you're having the same conversation twice with two different people on the same day, to really dig into and explain the difference between ETFs and mutual funds. You see those two different approaches being used out there in the financial services industry, and so we wanted to spend some time doing some comparing and some contrasting on it. And then we will, if time permits, talk a little bit about some of the things that you can do to hopefully manage more effectively your 401k. So those are the topics that are on our plate for this morning, but there is always room on the plate for your topic as well. So if you'd like to add to that list, feel free to give us a call, 407-916-5400. Toll free, 1-855-545-1025. Or, and this has been working relatively effectively now for the past couple of weeks in particular, you can send us an email. That email is my first name, Joel, Joel, at Nelson, Nelson, obviously for that, NelsonFinancialPlanning.com. So that's how you can get in touch with us and add your topic to our list of topics that we'll try and cover this morning on the radio program. So let's begin. ETFs versus mutual funds. So ETFs have become very, very popular of late, and we wanted to take a moment and sort of describe the differences between that and an actively managed mutual fund. So with an ETF, it's basically a basket of stocks. It's a static basket of stocks. So much like a mutual fund, it is a basket of stocks. Both of them are basket of stocks. But with an ETF, those stock holdings do not change. And typically, most of the ETFs out there are sector-based. So you would own sort of like a financial services ETF, and you would own all of the big financial services companies out there. You would own in that ETF, and so the composition of that would not change. Meanwhile, a mutual fund, and certainly you could have a sector mutual fund that might also be in financial services, but for the most part, our focus would be to use a more broad-based general mutual fund that would be able to go where the opportunities are, regardless of your industry sector. So that sort of tells you a little bit about where we might be a little biased here. Obviously, bigger fans of the mutual fund approach versus the ETF approach, because particularly by staying away from sector funds, you're able to move seamlessly across different sectors within that fund rather than be pigeonholed into that fund. Another big distinction is, if you stop and think about it, if I've got a sector ETF and I own the basket that is the financial services companies, okay? That basket includes everybody. Well, there's no way that everybody in that sector, every company that's in that business, is doing great. That's not possible. In any sector of the economy, when you look at a company, it's going to be a good one relative to its field, or it's going to be lagging relative to its field. But when you own a basket of all of those companies in that sector, well, guess what? You own the good ones and the bad ones. Meanwhile, on the mutual fund side of things, the active approach, you're not going to be owning everybody. There's going to be some selection as to which ones that you actually own. So again, from an investment perspective, why our bias is more towards the actively managed mutual fund side of things rather than the ETF side of things. Thirdly, on that list is that if you're using ETFs, it requires you to kind of get in and get out of the sectors, if you will, on a regular basis, and almost get you more into that timing exercise, which, if you know anything about our philosophy, we don't think that trying to time the market is going to be a worthwhile proposition. It is time in, not timing, that makes the biggest difference. Far too many people still believe that that it's possible to move money around based upon the headlines, based upon what's going on in the economy, and that somehow you're going to somehow come out ahead, okay? For those of you who don't have memories that go that far back in our company's history, as an aside, we used to have a company called Nelson Investment Timing Service. And that was probably 25 years ago. And it was my late father-in-law, Jack Nelson, and our PhD economist, Frank Dass, who retired at the beginning of the year after being with us for 30-odd years. and they would move between stocks and bonds and cash. And they did that for a couple of years, and then they looked at their results and they said, this is ridiculous, and they sent everybody their money back. Okay? Been there, done that. It doesn't work, very simply put. So we don't use that approach because you really can't do it effectively over time. Far more important to have time in as an investor rather than timing. So that creates sort of our bias based on our experience of what actually works and why we prefer the mutual fund approach, particularly the actively managed non-sector mutual fund approach to the ETF approach. Now, so those are all the pros. So let me give you the biggest argument that you hear for ETFs. And we're going to debunk that pretty quick once you hear the numbers. And we're going to do that, but we will do that after these messages. So hang in there through the break. Okay, this is a biggie. We're going to hit what the biggest positive to ETFs are in the conversation you hear out in the financial services industry. And we're going to dispel that myth. It's not really a myth. It's actually, we're going to dispel that because there's something else at play that you don't realize. So we'll hit all of that when we get back here on Dollars and Cents with Joel Garris of Nelson Financial Planning, News Radio 1025 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. On the program this morning, we started off with chatting a little bit about the differences between ETFs and mutual funds, really explaining sort of our bias on why we prefer actively managed funds versus ETFs. ETFs are basically static baskets. They don't change. A mutual fund, if you're using an actively managed one, is absolutely going to change. ETFs are generally sector-oriented, which means that you're going to own pretty much every single company in that sector. And when you stop and think about it, that doesn't make sense because in any sector of the economy, financial services, healthcare, or what have you, there are companies that are clearly doing better than their competition. But when you own a sector fund, you basically a basket, ETF basket, you basically own all of them. So why would you do that? It would seem to me that would basically be a bit of a drag on the performance of the ETF anyway. And then, because ETFs are much more of a sector orientation, the suggestion is that you're going to be able to rotate in and out of sectors and ultimately over time somehow time the market. We wish you well on that. Now, what's the single biggest argument that you hear for ETFs? Well, it's very simply the cost, right? Because the cost of an ETF is always going to be lower than a mutual fund. No question at all on that. Because an ETF, again, static basket, we look up the 30 large companies that are in the financial services companies, that are financial services companies, and poof, there's our ETF that is financial services. We look over here to the healthcare industry, and in the S&P 500, there are 30 different companies. So poof, there's our healthcare ETF. There shouldn't be any cost, let alone a cost. There should be next to nothing in terms of those ETFs. And generally, ETFs still have a cost. So that's a piece that often gets forgotten in the conversation, is that even though the ETFs are very cost effective, they still have a cost. And typically that cost is around 30 basis points. If you've got a more narrowly focused ETF, you can actually see that cost going up. And we've seen in some cases where that cost can be 0.8, 0.9 per year on an ETF. It just depends. But we'll just stick with the more classic ETFs out there, and let's say it's 30 basis points. Okay? So that's obviously much cheaper than your typical actively managed fund, which might be around, well, the good ones are around 75 basis points. Okay, there are certainly a lot out there in the mutual fund industry that is much more expensive than that. Same thing can be said for the ETF industry, but we're comparing sort of the classic choices, the better choices of them. And so generally it's 30 basis points on an ETF, and on an actively managed fund, it might be 75 basis points. So the conversation then is, well, that's a pretty big gap, and ultimately there should be some savings. Here's the rub, if you will. Here's the rub. What the industry is doing is that they have raised their compensation that you pay them by oftentimes way more than that differential in pricing. Let me see if I can say that again. Okay. So they're using basically a cheaper product, but they're charging you more money for their services. And you have to add those two together. It's not enough for somebody to just wave their hands and say, oh, well, the ETFs don't really cost that much. Well, I understand that, but they still cost money. And you have to take that cost and add it to the fee that's being charged. So let's use a very real example where the investor was getting charged a fee at 1.7%. Okay? That's a pretty hefty fee. Oh, but we're using ETFs, so it's really, really cheap. Well, yeah, but you still got to add those together. And I didn't major in math in college, but that 1.7 plus a 0.3 would put you at 2%, which is pretty pricey when it comes right down to it if you're looking for advice in the financial services industry. Unfortunately, what has happened, particularly over the past decade, is that's sort of the average, which kind of a sad statement on where the industry is and how much it costs investors to actually do business with somebody to get advice on a regular basis. But that's been the trend in the industry, and when you add those two together, it's close to 2%. Well, then, what was the point of that? Why are ETFs becoming so popular? Because the industry is charging more and pocketing more and eliminating the middleman that would be that actively managed mutual fund. But they haven't actually resulted in a cost savings to you. You're paying more. And, in our opinion, you've got an inferior investment. You've got an investment that's not going to change. You've got an investment that's going to own everybody, regardless of whether they're good, bad, or indifferent in a sector. And you've got an investment that's somewhat reliant on timing rather than actually owning a good investment and owning that investment over time. So certainly some things to think about as it relates to that ETF versus mutual fund discussion. I think far too often the ETF conversation doesn't look at those investment factors that we view as being a drag on the performance of your typical ETF, but most importantly, doesn't look at the fee structure that applies to those ETFs, where the underlying fee that the client pays is a whole heck of a lot more than they would pay using some more traditional mutual fund, brokerage-related type of services. Run the numbers, do the math. The popularity of ETFs has been driven largely by the financial services industry attempting to increase its profit margin. No other way to say it but that. That's what's going on out there. Be careful. They're really churning up the volume, particularly on this fee-only and fiduciary conversation, as a means to ultimately cost you more money. If your financial company or financial advisor, whoever he or she may be, hasn't been operating as a fiduciary for the past 30-odd years, then shame on them. It shouldn't have taken a marketing effort by the industry for them to change their opinion on that. That's where the ETFs also are coming very much into vogue. Because then if they charge the fee, then it's not quote-unquote hidden, and it's just fee only. Well, guess what? Okay, if you're not breaking down the cost of the ETFs and adding that in to the total amount that the cost is to the client, then guess what? Then you're not really disclosing the full amount. So you're not really being much of a fiduciary, in our opinion, on that. Anyway, we digress on that topic. We'll shift gears. And before we get to the break at the bottom of the hour, we'll hit the headlines a little bit. So trade war, obviously, I guess, officially started on Friday when $34 billion worth of Chinese imports, tariffs on $34 billion of Chinese imports took effect, and China responded with their own tariffs on farm products. Some interesting discussions in both the Wall Street Journal and Barron's magazine over the weekend that says if you're going to go down this path, right now may be a very good time to go down this path because the U.S. economy appears to be tracking differently than the rest of the world right now, because the U.S. economy is experiencing another uptick in economic growth. Many of that is related to the fact that capital expenditures are going up. If you look at some of the benefits of the tax changes that happened in 2000 and at the end of 2017, those have really just begun to come fully online for the year 2018. So, and we're talking more on the corporate side of those tax cuts, particularly the repatriation, bringing a lot of cash in. That cash is then turning around and getting used, and it's also driving not just down unemployment, because the unemployment number actually went up, but you have to realize the unemployment number actually went up because more people came off the sidelines. More people came off the sidelines feeling encouraged, feeling better about the economy, better about their prospects. So that's the backdrop. Meanwhile, if you look at Europe, if you look at China, their economies are not nearly on the same economic footing as ours. So there's a lot more leeway to be able to, I guess, fight this battle from the U.S. side of things. Barron's has a headline, given the strength of manufacturing, if you're going to impose tariffs, this may be the time to do it. So the economic conditions are lining up to help absorb whatever the impact is on this tariff activity. And certainly, let's be clear, there's a lot of evidence that points that China has not been dealing very fairly in this conversation for decades, and how they require intellectual property to be given up by U.S. companies in order to do business in the Chinese market. There's that evidence is crystal clear. So it's been going on for decades as companies were desperate to get into that market of 2 billion people. Everybody sort of looked the other way. Well, at some point, you probably don't want to give up your technology quite that readily. If you believe the markets, and we believe this, if you believe the markets are an accurate indicator of what the economic future holds, well, consider this. Since the tariff conversation heated up in mid-June, the S&P 500 is basically flat. The German stock market has dropped by 5%, and the Chinese Shanghai has dropped by 9%. Even if you might say there are no winners, equity markets are suggesting that the U.S. may be in a relatively stronger position in this conversation. Stay tuned on that. As we said, we communicate with our clients on a very regular basis. So we sent out a communication at the beginning of this past week. Obviously, it was marking the half-year point, giving our thoughts and our comments on, kind of the mid-year and the year so far and the year ahead. And the comment really on the tariff is one that we've made before on the radio program, which is that we suspect that a lot of this is just very boisterous negotiation tactics. Obviously, stay tuned. We'll continue to feature it as a topic of conversation on the program because it is a headline that does have the potential to have some economic impact. So that's the wrap up on the trade side. We got to slide to a break. When we get back from the break, we will recap and finish up the conversation we started last week about how to plan for retirement income. So stay tuned on that conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is Joel Garris of Nelson Financial Planning. So, full conversation so far. Talked a lot about mutual funds versus ETFs. Hit the trade war headlines in the first half of the show, and now we'll shift gears. I want to do some cleanup on a topic we started last week about retirement income and how to plan for retirement income. And then if we have time, we will talk a little bit about some 401k tips to consider. And then certainly plenty of time to also add in your topic of conversation as well to the program. You've got three choices. Well, really two choices. First, you can call 407-916-5400. Or if you would like to use the toll-free number, that toll-free number is 855-545-1025. That's option one. Give us a call. Option two is you can send us an email. The email is my first name, Joel, Joel, at NelsonFinancialPlanning.com. Those are the ways to get in touch with the program, and we'll get your topic right in the mix. So we'll shift on to retirement income. And last week we started talking about this at the very end of the program because there's some studies out there that suggest that almost half of the people out there don't have any plan for income in retirement. So when the paychecks stop, how in fact are you going to really generate out income that's going to meet those expenses? And so that really does give you a little bit of insight into where to start first, right? Start first with your expenses. get a handle on what those are. Those can generally be categorized as fixed expenses or rising expenses or discretionary expenses, and really kind of think about it in terms of those categories to help stimulate your mind as to what it is that I'm going to spend money on in retirement. So fixed expenses are things like your mortgage, right? And generally any debt that you might have, those are generally car loan. I mean, those are going to be fixed expenses, meaning that regardless of what happens, the payment on those is not going to change. It is set in stone. Meanwhile, the next category, rising expenses, well, those are things like healthcare, right? Food, the cost of food keeps going up. Utilities, things like that are of that category, more of those rising expenses. And then lastly is sort of that discretionary expenses category, things that you like to do, but you don't, that aren't a must, if you will, right? It's a must to have food. It's a must to have a home. It's not necessarily a must to travel, but we certainly would like to in retirement or play golf or whatever your hobby of choice is. Those really are your discretionary expenses. So if you think of it also in terms of how you line up your investments, the ones that would have relatively great stability in terms of income would be those ones that you would sort of want to match up with your fixed expenses, meaning ones that might go up a little bit over time. Those would be the ones that you would match to your rising expenses, and then your discretionary expenses might be those that have the potential for the most amount of growth potential, because those are more on the discretionary side of things. So when you think of it this way, when you start to plan that income in retirement, it really does start with figuring out the categories and the amounts as well of those various expense categories. So because then you could say that as you then start to look at the various places that where you could get income, you always want to kind of match those or make sure that they are going to cover the various categories. So it obviously starts first with, when you're thinking about your income in retirement, it starts first with Social Security. The vast majority of people, if they've been working, are going to be eligible for Social Security. So then that becomes sort of the bedrock of the income that's coming in, because that's the very essence of guaranteed income is Social Security. Yes, there are certainly headlines out there that suggest it's in financial trouble. I would suggest that the solution is out there. It's probably, if you're collecting Social Security now, it is incredibly unlikely that in fact is going to affect what you're getting. And think about the generations behind you, that the deal may very well change. But for planning purposes, if you're 5 years or so away from retirement, then Social Security is going to provide sort of like that base, if you will, of the income that you want to try and match up with your fixed expenses. Similarly, a pension would also be in that category if you're a retiree from the state or maybe a private employer and had a pension, then those amounts will be fixed, and maybe some of them might be adjusted for inflation a little bit, but basically that's a relatively stable level of income. And then as you look to the rest of your investments, then you might be able to start to match up funds that are more balanced in nature, part stock, part bond. You might match the income out of those into the rising expenses category. And then similarly, more growth-oriented, more equity-oriented investments you might use for discretionary expenses. So really the concept of developing your retirement income plan really starts with getting a pretty good handle on what your expenses are in retirement, and understanding the difference between expenses that you must pay, your fixed expenses that are ultimately going to be costing you more along the way, things like healthcare and food and stuff like that, and then things that are really of their nature fully discretionary. So start to think of your expenses in those ways so that you can start the process of planning for retirement income. So in a large respect, it starts by sitting down and really working through the expenses first, and then it shifts gears to where are you getting income from, Social Security, pension, or what assets do you have, and what's the appropriate level of a withdrawal rate. And because withdrawal rate on your liquid assets like your mutual funds or your stocks or your bonds or your 401k, those help to determine not just the level of income you're going to get, but also the ability of those assets to sustain themselves. Because if your withdrawal rate is too high on your assets, guess what happens? You run the risk of running out of money. If your withdrawal rate is too low, then you're not perhaps enjoying and doing as much as you could be doing if your withdrawal rate is too low. So both of them are unique problems, and each one of them has its own issues. Again, withdrawal rate too high, your biggest issue there is you're going to run out of money. Your withdrawal rate too low, perhaps you're not able to enjoy your retirement as much as you could be. So that's why it's important to really look at that overall withdrawal rate, which is very simply calculated by this. Take the money that you're planning on getting out of that investment on a monthly basis, multiply it by 12, and then divide by the total amount of assets in that account. That gives you your withdrawal rate on those investments. And ideally, you want that number to be around 4 or 5%, depending upon how the assets are allocated. If you've got them allocated predominantly on the bond side, well, then I would suggest that you change that, number one. And number two, probably use a withdrawal rate that is only 2 or 3%. So you see the difference in terms of how much income you could potentially be getting out with the proper investment allocation in retirement as well. But that's why the withdrawal rate is a pretty important and a pretty powerful thing to consider with respect to planning your retirement income. We'll slide to a break. When we get back, we'll have some final thoughts on this, along with some final thoughts on the program itself. This is Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. Before the break, we were talking a little bit about how to start to pull the pieces together for a retirement income plan. Nearly half the folks out there that are approaching retirement don't really have any idea how they're going to generate out retirement income. And so we will walk you through the highlights of that process now. Number one, it starts by figuring out your expenses. Don't start with assets. Don't start with income. Figure out what your expenses are. And generally, those expenses are going to fall in the category of fixed expenses, things like mortgages, things like that. Rising expenses, things like healthcare and food. and then purely discretionary expenses, which would be travel or hobbies or things like that. And then that really does allow you to see, okay, how much retirement income am I going to need to, number one, survive? I got to pay my fixed expenses, and I got to pay for food and things like that. And then how much would I like? I've got some discretionary tastes that I want to do on a regular basis, so I want to make sure that my income is sufficient to cover that. So looking first at the expenses sort of helps to establish that minimum, maximum range of retirement income that you need and that you would like to have. So start first with the expense conversation. Then you start to turn to, okay, what's the income look like based upon the income that's automatically coming in? That would be things like Social Security or a pension or those types of automatic check-a-month type things that are going to come in no matter what. Those items provide the very sort of foundation, if you will, of a retirement income plan, because that income is always going to come in and you don't really have to worry about whether it's going to come in or not. Ideally, you want that foundational income, automatic income, to certainly match those fixed expenses and as much of the rising expenses like food and healthcare as possible, because that income, again, won't be shifting. So that's sort of the foundation of your retirement income plan. The next part that you have to look at is looking at, okay, here are all my other assets, whether it's 401ks, 403bs, money that you've invested and saved, the other assets. So then on that total amount, you want to pick a withdrawal rate. Now, be careful on the withdrawal rate. If it's too high, you're going to run out of money. If it's too low, you're not going to enjoy the retirement that you work so hard to do. So generally, if you assume a 4 or 5% withdrawal rate on it, then you can calculate how much additional income to add into that retirement income plan. So let's use an easy number. Let's say there's $1 million. So 5% of that is $50,000. So that's about $4,000 a month of income that you can then add into your retirement income plan. Okay, so now you've got something that looks like it is your income in retirement, but there is one more step to do. You've got to now look at how the assets are allocated, because remember, it comes back to that withdrawal rate. The withdrawal rate that you're using has to be the right one, and that is directly correlated to how your investments are allocated. If your investments are sitting all in cash, you can't use a withdrawal rate of 4 or 5%. You're using a withdrawal rate of maybe 1%. If your assets are sitting all in bonds, you're not using a withdrawal rate of 4 or 5%. You're using a withdrawal rate of 2, maybe 3%. So the conversation ultimately about your retirement income plan ultimately gets back to how are the assets actually invested and what's the assumed rate of return that you can put on those investments going forward. If it's all in cash, it's 1%. If it's all in bonds, it's 2 or 3. If it's in a mix of stocks and bonds, and helping to adjust that allocation is certainly one of the things that we do every day for folks in the office. That then would allow you to get to that 4, maybe even 5% withdrawal rate. So that's sort of the foundational concepts of how you develop a retirement income plan. It is a very extensive process, an extensive analysis. We've tried to hit the highlights for you so you can think about getting that going today if you are approaching retirement and don't have one. we got to roll out of here. So we will wrap it up. Thanks for listening to the program. This has been Joel Garris of Nelson Financial Planning here on Dollars and Cents News Radio, 102.5 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.